I think that this is just a great topic because we have seen a sell-off in some of the high dividend yielding stocks, such as utilities, after yields did jump up so much after the election. What's going on here with these ETFs? And what is the difference between the Treasury yield and the dividend yield on these ETFs?
Sure, right. So the Treasuries have quietly jumped. The 10-year note is now yielding 2.4%. So that puts it above, for example, 3 of the top 10 biggest dividend ETFs. Now, remember, for 8 years, dividend ETFs, they did lead a charmed life because they had 2 things going for them. They held equities in a bull market, and they yielded more than Treasuries. So you saw $140 billion rush into these things. And now everybody's focused on Trump and what he's going to do. But quietly, you know, with these yields inching up and then 3 hikes expected this year, this is a lot of money that could be at stake here. There's 2 types. There's the growers, which look for companies that have appreciated their dividend over 10 years or 20 years. Those tend to be a little less rate sensitive because they don't hold utilities. But then again, those also yield like 2%. Then you're going to the high dividend paying ETFs. Those go after the ones that just yield the most. Then you get into utilities and telecom, and those are going to be more vulnerable to rates in terms of their performance. So either way, you're looking at some new tension that is in these ETFs.
Yeah, very interesting for sure. And so in doing a little research for this segment, it looks like VIG, the biggest dividend high dividend yielding ETF, yields about 2%, much less than the 10-year note. What gives here? What would possibly make it attractive right now to investors?
Yeah, I mean, how about that? That's also the same as the S&P 500. So VIG is $23 billion. This thing has been the biggest dividend ETF since it came out, basically. And yeah, it's yielding 2%. That's 40 basis points less than the 10-year note. It's because, here, look, it basically has a strict criteria. It looks for companies that have increased their dividend for 10 years straight. So you end up with like Microsoft, Johnson & Johnson. Then it market cap weights them, so it gives those companies even more weighting. So you're basically putting a real net on top of any type of yield, and so that's why you get a 2% yield here. But it's unclear how many investors might use an ETF like this just for the stability of some of these stocks, and they just think dividend payers are good companies to own, versus, hey, I want yield. That will something we're going to find out soon, because the people who went there for yield are probably going to leave.
Yeah, that's a pretty good point there in terms of having those high-quality stocks in there, plus the dividend. Now, very quickly, how is this affecting outflows?
Yeah, so dividend ETFs taken in a couple billion since Trump won and rates went up. But that's not much considering the flow-a-thon that has happened since he won. $180 billion have gone into ETFs, mostly equities. So if you're only taking a couple billion of that, you're not really taking in as much as you normally do. And so we saw value has come back and knocked off dividends as the biggest category of smart beta. So dividend ETFs are not really pulling their weight in flows, and we'll see if it turns to outflows at some point.